The Bank of Uganda officials who were before the Finance Committee of Parliament indicated that the debt stock has accumulated to 79 trillion shillings, which represent 49% of the 160 trillion shillings gross domestic product. But with the inability by the government to finance on budget, the debt stock is planned to hit a 53% high in the next financial year. Out of a total 49.9 trillion shillings proposed for the 2023-24 budget, government only expects to generate 29 trillion shillings, the rest coming in from loans and grants. Bank of Uganda cautions against loans with shorter grace period.
We have advised government that if you are going to contract any commercial loans, they should have a grace period of 4 years, because we don't want anything to mature within 4 years, since we are already laden with a $900 million debt service payment in the next 4 years.
This is so because the accumulated loans are envisaged to be serviced with the oil and gas money, for which the first drop is expected in 2025. Even then, the government expects the oil sector to drive economic growth in the next financial year by a 6% rate, opposed to the gloomy global outlook in which the growth is projected to return to 2.7%, up from 3.2% currently.
Very soon we are going to be announcing the FID on the refinery, and a number of foreign direct investments are coming in to support our own investments.
Atingi-Ego warns that should there be a change in investments in the oil and gas sector, things could terribly go wrong for the economy.
So what happens? The balance of payments deficit increases. And when it increases, the exchange rate adjusts. So the exchange rate has got to depreciate. And the depreciation of the exchange rate is meant to correct those imbalances. So it means that the exchange rate will depreciate much faster.
As it is today, we have all the necessary legal frameworks in place, and we are busy implementing all the interventions that are required in this sector. So we are still on schedule.
So are you suggesting...
But at the same time, we need to emphasize, like the governor is indicating, the issue of enhancing our exports.
The officials at the Ministry of Finance, Planning and Economic Development contend that they have not put all the eggs in one basket by hoping for better economic performance in the next financial year based on foreign investment in the oil and gas sector. The other resilient sectors they talk about are the agriculture and tourism sectors, but which members of parliament say, as planned, have not received adequate budgetary allocation. Jackson Onyango, reporting for NTV.